A very good afternoon to you, friends. I'm Sanjeev Singhal, Central Council Member and Chairman, Auditing and Assurance Standard Board. On my behalf and on behalf of the board and my Vice Chairman, CA Vishal Doshi ji, I I welcome you all third program of AASB for this council year. And friends, today's topic is uh, again uh, relating to audit, auditor's responsibility relating to fraud and an audit of financial statement. And I'm very thankful to the Jalandhar branch chairman, CA Abhishek Bansal ji, for agreeing to co-host this program with AASB, and to CA Milan Modi ji uh, for for agreeing to be the guest speaker. Uh, it's been a constant endeavor of the Auditing and Assurance Standard Board to improve the audit quality and to keep our members updated on various aspects relating to audit. With this, I would like to hand it over to my worthy chairman from Jalandhar branch, a very young and dynamic C. Abhishek Bansal ji, to kindly take over the proceeding and also introduce our speaker for the day. Over to you, Abhishek bhai.
Thank you so much, sir. A very good afternoon to everyone. I, C. Abhishek Bansal, Chairman, Jalandhar branch of NIRC of ICI, being the moderator of today's webinar, welcome you all to the webinar of today. The topic of today's webinar is Auditor's Responsibility Relating to Fraud in an Audit of Financial Statements. First of all, I would like to thank the Chairman, Sir, CA Dr. Sanjeev Kumar Singhal ji of the Board, Audit and Assurance Board of ICI for giving me this opportunity. Thank you all the members of the board for considering me as the moderator of today's webinar. Now, I would like to introduce the speaker of today, CA Milan Modi ji. CA Milan Modi ji has got CA Milan Modi ji is All India ranker in both CA Inter and CA Final. He is into audit practice since last 26 years. Areas of expertise include statutory audit, management audit, due diligence review, and IFRS. He is also the joint managing partner in NA Shah Associates LLP. He has made more than 55 representations at various forums, namely BCAS, WIRC, and its branches, Chamber of Tax Consultants, CPE study circles. The topics of presentations includes Auditing and Assurance Standard, Accounting Standards and Ind AS, Companies Act 2013, Schedule 3 and CARO, Corporate Social Responsibility, Due Diligence Review, and Internal Audit. He is also technical reviewer of annual reports for ICI Awards on Excellence in Financial Reporting for 4 consecutive years in the year 15-16, 16-17, 17-18, and 19-20, and for the year 2021 also. He has authored various articles published in newspapers, online portals, and professional journals published by BCAS, CTC, and ICI on technical topics related to audit. He held committee member positions at BCAS, WIRC, and CTC. Contributor to WIRC reference manual for last 5 years, part of group which assisted the peer review board to incorporate section of AQMM in the peer review manual. He is also the co-author to publication by Taxman and CTC on CARO 2020, published in August 2021. And there is many more for Milan Modi ji. Sir, I welcome you to today's webinar. Now I will hand over to you. Thank you so much.
Thank you, Abhishek, for those kind words. And thank you, Sanjeev ji. Thank you, the Auditing Assurance Board, for this opportunity. The topic is really very interesting and important. And before I put in my slides, I think this is something of interest for the country at large, that auditors' responsibility on the various frauds which are there, mainly, namely financial frauds. So I'll start my PowerPoint presentation. Is it visible, Abhishek ji?
Yes, sir. It is visible.
Yes, sir. Yes, sir. Make it full screen, sir.
Yeah.
Yes, sir. Fine, sir.
Okay. So, as Abhishek ji and Sanjeev ji both mentioned, that the auditors have a lot of responsibility on the reporting which they do. And over the years, one of the area where the auditors are responsible is to ensure that the financial statements are free from any material misstatement, either due to fraud or due to error. And that is where the first time the word fraud was there in the audit report. And subsequently, after Companies Act 2013, and after the new Caro 2020, and even in the earlier Caro 2016, there are reporting requirements from the auditor on the frauds. So we'll see some part of it as we go across the slides. I mean, to start with, the NAFRA chairman very clearly said that auditors are not expected to detect fraud, but they must follow the due process laid down in the regulation. So, though they are not directly or primarily responsible for identifying and detecting all frauds, but they need to follow the audit process with due diligence and abide by the regulations. And during that process, if they identify something, then they have a responsibility to report. So this is something which was very recently shared by him in one of the forums. And I think I found it very appropriate to start the presentation with this statement from Ajay Bhushan Pandey sir. And I think it's very relevant that we understand that as auditors, there is a lot of expectation from the general public or the investing public from the auditors when the fraud is identified. And those expectations are that what was the auditor doing while the fraud was happening? Were they aware? Once they were aware, did they take any steps? How did they respond to that fraud? And these sort of questions do come up from the investee public. And as auditors, we are responsible, at least morally, and obliged to ensure that we follow the correct process and report appropriately and respond appropriately. This is one of the judge, and subsequently he's in law practice, and he said that the fraudster's greatest liability is the certainty that the fraud is too clever to be detected. I mean, for us to understand fraud, we also need to understand the mindset of the person who's doing that fraud, or at least have some basic idea about it. And I think anybody who is doing something intentionally to deceive would always feel that his plan is flawless and it will not be identified or it will not be detected. So this is something which we should all keep in mind, understanding the psyche of the person who is doing wrong, because that would help us both uncover if that is our responsibility, or if it is uncovered, to address it in a better manner. Uh, 240, SA 240 covers the aspect of what are the auditor's roles and responsibilities with regards to fraud in financial statements. And the standard is quite exhaustive. I think it runs into various pages. So it's very difficult to summarize everything which is there in that standard in a short period of time. But just to highlight a few aspects of the standard talks about the characteristics of the fraud types of misstatements, or what does the fraud lead to in terms of the financial misstatements, material misstatements, the auditor's responsibility. And the auditor's responsibility circles around the assurance that these statements are free from any material misstatement. The another responsibility the auditor has is to approach this subject or topic of fraud with professional skepticism. And I think this is a very important mindset, because of which the auditors gain that respect, that they do not take things at face value. They look at it from a doubtful perspective to some extent, and they gather evidence to finally reach a conclusion or an opinion. The next step is the steps to be performed by the auditor in respect of this particular area, that is relating to fraud in audit of financial statements, which is do the fraud risk assessment, inquire with the management, look at the internal control environment, and respond to the risk in an appropriate manner. So if the risk is high, your substantive checking has to be that much more, or you may expand your sample size. And if the risk is low, you may be able to do with a lower sample size. or so additional evidence has to be gathered if the risk is higher. Documents to be maintained, documents with respect to inquiries made with the management and their responses, the management representation letter, again a very important document, and that representation should very specifically cover 3 or 4 aspects with regards to fraud by the management, about sharing transparently the knowledge which they have with respect to the frauds which the management has identified. The last part is to respond on the fraud risk. What are the additional audit procedures which I spoke about, whether you do a sample size increase, whether you do substantive testing, whether you gather more evidence. The implication of after the additional audit procedure on the audit opinion, communication with those charged with governance, and evaluate need to report to the regulators stroke authorities. SA is not very country specific, and hence it will be more broader. SA is applicable to all types of entity, whether it is company or a non-company, and hence some of the terminologies which are used in the SA are more broader in nature as compared to what the Companies Act very clearly specifies. Yeah. With this background about the auditing standard 240, let us go ahead in detail on each of these 4 or 5 items and expand it a little bit. Post SA 240, we will cover other regulatory aspects, which would include the reporting under Companies Act, under CARO 2020, and the recent NAFRA circular. So, what is fraud? SA 240 defines fraud as an intentional act by one or more individual among management, those charged with governance, employees, or any third party, involving the use of deception to obtain unjust or illegal advantage. I mean, it's a broad term. And to some extent, there could be a legal interpretation which may be involved in the interpretation of what is fraud and what is not a fraud, because for an auditor or for a chartered accountant to conclusively say that this is a fraud would be difficult if he is the one who has identified. He cannot sit into the judgment and the merits and say whether this is a fraud or not a fraud. So he will always have a suspectful transaction or indications that fraud has occurred. So fraud is a broad legal concept which includes fraudulent financial reporting and misappropriation of assets. And the auditor or the SA focuses mainly on these 2 aspects, on the financial statements, so material misstatement of the financial statements or misappropriation of the assets. As I said earlier also, that any fraud or any fraudster will generally we need to understand the mindset with which they work, or the psychology with which a fraud is conducted. And there are 3 very clear indications over here, which is called as a fraud triangle. They would always try to rationalize their thought process of what they are doing is right. They would have an opportunity. So there are controls which are either loose or inadequate, and that gives them the opportunity. And obviously, then they will have a self-interest or a motivation to do that. Rationalization is trying to say that, I'm doing so much for the company, and the company is not compensating me sufficiently, and hence it is correct for me to take away certain money from the company. Opportunity would be where he has powers which are unchecked, or there is a maker-checker concept, or those things are not there, segregation of duties, which gives him the opportunity. And the motivation would be either personal pressure, or it's like it becomes like a mind game, or a challenge for somebody to say that, no, I can also do it. So this is just a little bit of a general on the topic of fraud. Coming back to the SA 240 and the auditing standard, because we are not detectives or we are not policemen to really go after fraudsters. But the standard broadly defines the misstatement, material misstatement in financial reporting as fraudulent financial reporting and misappropriation of assets. If within that there is manipulation, which includes forgery. For example, if you remember what happened in case of Satyam is that the FDs, the PDF statements were forged and they were shown to the auditors. So that's manipulation. Misrepresentation or intentional omission of certain facts. So there is some loss which has occurred to the company, but you have not shared that information, and that leads to a subsequent adjustment and not during the reporting period. So, those are the misrepresentations which are sometimes provided. Intentional misrepresentation of accounting policies. You know that certain accounting policies are not appropriate. For example, useful life. You tend to use a useful life higher than what the asset can actually be economically useful. In such case, it is an intentional misrepresentation of accounting policy. All those things lead to a fraudulent financial reporting or the financial statements. Misappropriation of assets include misappropriation of goods or defalcation of cash or any other assets of the company. So goods would include not only the inventory but any other assets belonging to the company. So pilferage or shortage in inventory verification, all those are items of misappropriation of the resources of the company. So this is something which needs to have attention of the auditors. So what is the auditor's responsibility? I did briefly touch upon the various parts of that. He needs to obtain a reasonable assurance that there is no misstatement. In case the risk of non-detection is higher when on account of fraud as compared to an error. Error may be slightly easier to identify because there is no intention to conceal. Whereas in a fraud, there is an intention to conceal, and hence identifying it becomes that much more difficult. If it is done by the top management in collision, it becomes that much more difficult for the auditor to identify or anybody else to identify such type of frauds. And hence auditors should maintain professional skepticism throughout the audit period. Is it the auditors responsible for prevention and detection of fraud? Answer is no. Both those charged with governance of the entity and management have the primary responsibility for preventing and detecting of fraud, and not the auditor. But the auditor does have other responsibilities, which we will see further in detail. Some of it we have already seen. Objective of the auditor is to identify the risk. Identify first, is there a risk that there could be a material misstatement due to fraud? He has to obtain sufficient and appropriate audit evidence to rebut this. And if there is a fraud which is identified or he comes, the management informs the auditor about the same, then he has to respond appropriately to the identified or suspected fraud. Here you need to understand that the frauds are of one which the management informs the auditor and one which the auditor himself identifies. These two have to be dealt with in a different manner. What is professional skepticism? I think it's very difficult to explain this part to everybody, that what is professional skepticism. But, it is something unique to all chartered accountants, and our audit training gives us this ability of a curious and questioning mind, a critical assessment, being alert, as we say, our motto says, we are awake in where everybody else is sleeping, and investigate the inconsistencies in responses provided by the management. So linking various responses, being vigilant, I think, and having a critical analytical mindset will definitely help us have that professional skepticism, which will help us perform our duties in a much, much better manner. Again, some sort of a repetition, but these are all covered under the auditing standard. Assessment of the risk, communication to employees regarding the view on business practices and ethical behavior. What is the management doing on that area? Obtain information used for risk identification and inquire with the management on controls and oversight. process of identifying and responding to risk of fraud and communicating with those charged with governance. The risk assessment procedure which the auditor needs to follow is inquire with the management of actual or alleged frauds, identify unusual or unexpected relationships and transactions, consider the information which may have an indication as regards the risk of a fraud, and evaluate any fraud risk factors which are present based on information obtained. So, there are various data points which the auditor will have to gather and then analyze that is there a risk that these financial statements contain any fraud? How does the auditor respond to this assessed risk? So the auditor risk of material misstatement due to fraud, and then risk of material risk related to override of control. So this is broken up into two parts. One is due to fraud and one is due to management override of controls. Then there is SA 330, where the auditor determine the overall response to address the assessed risk through planning and supervising his team in a different manner, evaluate the accounting policies for indications, and incorporate unpredictability or surprise element in the audit process and the audit testing. In case of management override, if he is suspecting that, then to mitigate that risk, he has to test the journal entries. He need to review the accounting estimates. So for example, if the warranty has been on an average 2% of the sales value, and suddenly management says that estimates that the warranty provision now needs to be at 1%, he will have to challenge those accounting estimates and say whether that change in accounting estimate or a reduced accounting estimate, does it lead to any misstatement or not? Evaluate any unusual transaction either between related party or non-related party, and perform additional audit procedures. So this is how the auditor needs to respond to the risk of a fraud which would lead to a material misstatement of the financial statements. Let's go ahead to evaluation of audit evidence, and the auditor shall evaluate whether the analytical procedure which they have performed indicate of any misstatement due to fraud or indicative of any fraud. So let's look at if the GP ratio has been a particular range and suddenly there is a fluctuation in a GP ratio, and he is not able to reconcile the difference between the previous GP ratio and the current GP ratio by a way of a proper, genuine, authentic reconciliation, then it may lead that there is some issue with the data which is provided. Either purchases are overstated because of which the GP is wrong, or sales are underreported because of which the GP is lower. In case of fraudulent misstatement, where auditor believes that the management is involved, he has to be extra careful, because otherwise in all other areas he is relying on the management for the data and the representation. But if he believes that the management itself is involved, then he will have to evaluate the response to the assessed risk. He has to handle it differently. We'll come back to that point again in detail in the subsequent slides. If the auditor is unable to conclude if the financial statements are fraudulently misstated, then the auditor shall evaluate the implication for the audit. So if he is not able to conclude either way, it's like a disclaimer, then also he will have to evaluate that does he need to include that inability as a part of his audit comment. Yeah. So these are, as you saw, these are the various things which the auditor is responsible in terms of assessing the risk, evaluating the risk, performing additional tests, speaking to the management, asking pointed questions whether the management has identified any fraud not identified, doing analytical procedure, and as and when he finds any indications or suspectful transactions, he obviously will have to use his professional skepticism and dwell upon that issue little more to gain more information and knowledge, and accordingly respond to it. Let's say there is a position that the fraud is identified and management is involved and management is not agreeing to some of the points which the auditor has raised. Auditor may decide that he will not be able to continue because there are too many issues which are there and it may be beyond both his capability or his willingness to go ahead. In such cases, he will have to look at his legal responsibility. Is there a requirement to report to the person who made the appointment about the, what led to the resignation or what led to discontinuation? Consider if it is appropriate and legally permitted to withdraw from the engagement. In case of listed company, you would be aware that there was this beverage company, and after which the government came with a change that in between the year, the auditor may not be able to resign. So if he has completed certain portion of the audit, he would have to complete the full portion. And there are 45 days before the period end is another, I think, the criteria for the auditor. So he has to decide in advance and he cannot at the last moment ditch the company and have the difficulty for the company to address and suddenly say that I will not be able to do this audit. If the auditor withdraws, then he has to discuss at the appropriate level with the management, the audit committee, those charged with governance, determine the professional and legal requirement to report to the person who made the appointment, which we already saw earlier. Subsequent to this instance which I spoke about, auditors are also required to provide reasons for resignation. And preoccupation is not one of the reason which is preferred. So you cannot say I am busy and hence I will not be able to continue with the audit. That is a very, very rare scenario where you will be able to use it. But otherwise, the reasons have to be more solid and concrete. And that has to be mentioned in the resignation letter and the form which is filed with the MCA. I spoke earlier about documentation both of the audit procedure and the management representation. And the auditors the auditor should obtain the representation as regards the design, implementation, and maintenance of internal controls, which would prevent and detect frauds. They have to disclose that the management has disclosed to the auditors the assessment of the risk that financial statements are free from any material statement or have a material misstatement which could be due to the fraud, either way. That the management has disclosed to the auditor that to their knowledge about any fraud or suspected fraud which may have an impact, and that the management has disclosed to the auditor their knowledge of any allegation of fraud or suspected fraud. So if there is any complaint, if there is any whistleblower complaint which has been lodged, the management needs to inform about it to the auditor. And now obviously in Caro, the auditor himself also have to make these inquiries as regards any complaint or whistleblower allegations which have been received by the company and how they are addressed. So this covers the main aspect of the auditing standard 240. I would highly recommend everybody to go through this standard because it's very difficult to summarize each and every para. It is a very, very heavy standard and with a lot of insights, a lot of information about what auditors should do so that he is in the right side of the auditing. And these are the steps, if they are properly taken, this would help the auditor in case the auditor was not able to identify a fraud. He can still substantiate that he followed all the process which was necessary as a professional, as an expert, as his responsibility, and he covered all the areas of risk assessment, of inquiry, of additional checking if required. And in spite of that, if he could not identify, then that is an inherent limitation due to which and not due to any negligence. Because when any at a later stage, if any inquiry is there on the financial statements, the auditor will also be asked and his documents will be scrutinized with a microscopic glass, with a magnifying glass, and hence it is very important not only for the auditor to follow each and every step which is narrated in the standard, but also to document them, make it self-explanatory, ensure that he has covered all the areas. He can use a checklist if required, to ensure that he has covered all the aspects within the auditing standard. Is the auditor responsible to inform the regulator or the enforcement authorities? Uh, there is generally a confidentiality of client information which may preclude the auditor to reporting. So, for example, if you find that there is a uh, concealment of an income leading to a lower income tax, do you have a direct responsibility as a statutory auditor? The answer may not be yes. If you are tax auditor, obviously the answer is yes. Or some other items which you have identified, do you need to inform the regulator? Generally the answer is no, unless there are specific questions which are asked or the law itself prescribes. Like in case of Companies Act 2013, itself prescribes that if the law is beyond a certain level, which is more than 1 crore, then the auditor needs to file a form with the MCA. So this is mentioned in paragraph A 64 to 66 of the SA 240. So as I said, do not take this subject lightly. This will have a very, very huge impact on you as auditors in case something is identified at a subsequent stage. And even, as auditors, when our files are go through the peer review or the QRV, we need to ensure that SA 240 has been fully complied with. And even from that perspective, I would highly recommend that you go through this and jot down the points for the clients which are relevant from your firm's perspective. I already spoke about this, about the 315 and 330, that the decision reached during the planning stage about the frauds should be documented. Any identified and assessed risk due to fraud should be noted. If there is nothing identified, that also should be noted that there were no indicators. The overall response to the risk should be documented, and the result of audit procedure, including those designed to address the risk of management override of control, should be documented. So this covers the first part of our today's discussion, which is basically talking about the SA 240, which covers in detail the auditor's responsibilities when it comes to fraud in an audit of financial statements. But as I said, SA 240 applies to corporate as well as non-corporates. SA 240 is more broader in perspective and not only to a company incorporated under Companies Act. It is to any attest function, any audit function. And hence we also need to look at the other regulations while determining the responsibility of the auditor when it comes to fraud. So let's go to the Companies Act 2013. The Companies Act 2013 has a definition under section 447. And that definition is different than the definition which is given in SA 240, though in essence and in substance, it would more or less include, there will be a lot of overlap and maybe just few items which could be different. So fraud in relation to affairs of a company or any body corporate include an act, omission, concealment of a fact, or an abuse of position committed by any person or any other person with the connivance in any manner with an intent to deceive, to gain undue advantage from or injure the interest of the company or the shareholders or its creditors or any other person, whether or not there is any wrongful gain or wrongful loss. So if you see this definition, it covers so many things, and it has a wide and a broad interpretation, and any wrongdoing anything which is not of the interest of the company, anything which is a self-interest, anything which is, misuse of power or position, anything which is a concealment, anything which is like, uh, insider information which is not shared, all those will get covered as a part of a fraud under section 4, as a definition under section 447 of the Companies Act. There is a guidance note on the 143.12. 143.12 is the section in which obligation is casted under on the auditors, that the auditor of a company during the course of the performance of his duties has reason to believe that an offense of fraud involving such amount or amounts as prescribed is being or has been committed in the company by its officers or employees, then the auditor shall report either to the central government, audit committee, or board, again, based on the rule 13 of the rules. And this is basically the limits and the cases where audit committee is formed, or cases where audit committee is not formed. Now, this is something which is very important to understand, that it includes a present tense, a past tense, a future tense, all three, because if the fraud is already there, if the fraud is happening at this point of time, or it is expected that the fraud will happen, reason to believe that the fraud can be committed or is being committed, all three of that would get covered. This section primarily deals with fraud which is committed by the officers or employees. So this does not cover the fraud which is conducted by any third party. We will come further to that because that's elaborated in the subsequent slides. And as I said, this is the auditor's responsibility requirement under section 143.12 to report when he has reason to believe that the fraud is happening or has occurred or is occurring. So what is the requirement? The requirement is of two, it can be bifurcated into two parts. The first one involving amount less than 1 crore, and where amount involving is more than 1 crore. If it is less than 1 crore, he has to report to the board or the audit committee, and this has to be disclosed in the board report. And he has to inform this within 2 days of him or her becoming aware about this fraud or suspected transaction or suspected fraud. The second instance is involving fraud in excess of 1 crore, where he has to report to the board and the audit committee within 2 days of him becoming aware, and then he has to seek a written reply within 45 days. And then there could be two scenarios, that he receives a reply or he does not receive a reply. In either case, forward, if the reply is received, forward the report plus reply plus the comments to central government within 15 days of such reply, or forward report plus note containing details for which reply hasn't been received to the central government. So he has to do this within overall 45 days plus 15 days if he has received a reply, otherwise immediately once the 45 days expire. And the report shall be in the form of statement as specified in form ADT 4. Yeah, ADT 4 is a form, and there the terminology, some of the terminology are different than as compared to the Act. So we will have to go broadly by way of the Act, but in doubt, you may want to cover additional points. The guidance note, as I mentioned on 143.12, very clearly says that the primary responsibility of detecting and preventing a fraud is of the management, and it is not of the auditor. So that's something which is an overview, as a background, and that remains constant, whether it was the essay, whether it was the NAFRA chairman, what he mentioned, or when it comes to the guidance note. Auditor's responsibility under section 143.12 has been elaborated in this guidance note. It is applicable for branch auditor. It also talks about whether it is applicable for branch auditor, internal auditor, secretarial audit or not. So it covers that aspect, and we will go through that in detail. It also talks about responsibility in case of a group audit, additional audit procedures in case of suspected fraud, and management representation checklist to be used, and the risk factors. So the guidance note is comprehensive, again running into various pages, giving a lot of insights to the auditors that how should they handle this particular matter. And obviously coming from the ICA, it will have a lot of weightage. If these processes are duly followed and complied with, then the auditor will not be questioned whether they did their job correctly or did not do their job correctly. First point I already spoke about. Section 134, subsection 5 states that the board report should include a responsibility statement, which inter alia states that the directors have taken proper and sufficient care of safeguarding the assets of the company and preventing and detecting frauds and other irregularity. So, this 134 subsection 5 also reiterates that it is the primary responsibility or the first level of obligation is on the management. 143.12 envisages the auditor to report to the audit committee or to the board of directors, and thereafter, where applicable, to the central government, an offense of fraud in the company by its officers or employees only if he is the first person to identify or note such instance in the course of performance of his duties as an auditor. Now here there is a crossroad, because 143.12, the interpretation in the guidance note of the Institute of Chartered Accountant is that only if the auditor has identified it, it is the auditor's responsibility to report to the audit committee and the board, and thereafter to central government if applicable. Whereas a recent NAFRA circular has taken a different view on 143.12 obligation of the auditor. We will see that portion a little later during the third section of our presentation. So again, to talk about 240, which is broader, 143.12, which is a narrower and specific. It is directive in nature. It is rule-based. It talks about a quantum. It talks about under the Companies Act. It talks about the what steps within what time frame is the auditor needs to take. The SA may not contain, SA 240 may not contain the time frame, but here it says within 2 days, within 45 days. And my interpretation would be 2 days, 2 working days. But again, you may not be able to take a chance when it comes to 45 days. For 45 days, I think you will have to include irrespective of whether they are working days or non-working days. But for 2 days, I think it would be fair and reasonable to assume that these are 2 working days. Yeah. So let's go ahead. The guidance note talks about audit procedure which the auditor can perform when he has reasons to believe that an offense involving fraud is being or has been committed. He needs to introduce a surprise element or unpredictability in carrying out his audit, reperforming certain critical reconciliations, critical evaluation, retrospective testing of accounting estimates. So for example, accounting estimate, we spoke about useful life. If and when there is a sale of an asset and if there is a huge loss which is booked, then you can question that if the loss is being booked, the reason is that the WDV was higher than the market value, which means that the accounting estimate or the useful life was incorrect. So these type of intelligent interpretation is something which you should do as an auditor when you find that there is a constant loss on sale of fixed assets. For RPT critically evaluating the business rationale and the arm's length nature, what is the reason of the related party transaction and whether it is fair for both the parties or not is something which can be evaluated. Though it is subjective, I think as auditors, we do get a hint if it is unfair or unfavorable or tilting towards favoring one party. We generally get a sense of it, but we do not want to stick our neck out. And that is where I think the auditor should be slightly more bolder. They should ask more difficult questions to management and ask the justification for the prices at which related party transactions have been conducted. Additional evidence may have to be gathered from external parties. So whether direct confirmation or any other method, the auditor will have to explore that. So let's say if inventory is something and he is not able to verify that inventory, then he may have to look at alternative procedures. Consulting experts for unusual and complex transactions. So if there are derivative transactions or linked transactions which the auditor finds it difficult to interpret or understand the future implications of that, he will have to go to an expert. Let the expert simplify the complex matter and explain the accounting implication. So if there are multiple transactions which are linked and that results into a future liability, whether that future liability needs to be recorded today or not is something which the auditor will have to analyze, evaluate, and conclude. So when does the auditor commence reporting? And here, I think as soon as he has a reason to believe that an offense of fraud has or is being committed by the officers. So reason to believe and knowledge, these are the two very important words. If it is he is in knowledge, then obviously that knowledge has come from somewhere, and or he has a reason, he has a doubt that there could be a probable fraud. Either cases he has to report in ADT 4. As I said earlier, fraud is a very, very complex and a broad terminology. You may not always able to conclude that the fraud has happened, and hence the reporting covers suspected offenses involving fraud. So you need not wait for the actual to conclude that the fraud has actually happened, because you are not capable of sitting in that judgment. But the moment you have an indication or suspect, you have to report in ADT 4. So the harmonious reading of both section 143.12 and rule 13, reporting on fraud in the course of performance of duties, is applicable only when the auditor has reason to believe and knowledge that a fraud has occurred or is occurring, and not in any other case. Yeah. This guidance note clarifies that it also includes branch auditors appointed under section 139 of the Companies Act. It does not include internal auditors under section 138 or the tax auditor. So they are not covered by this 143 subsection 12. Reporting is also applicable to the cost auditor and the secretarial auditor. That's mentioned in the section itself. In case of a foreign component, it is not required, not applicable. And in case reporting is applicable only in suspected fraud is being or has been committed by employees and officers of parent company, and it is against the parent company. So these are the points which need to be careful. The component may report on a standalone basis as respect to the component. The group auditor will have to focus on the holding company and focus on the reports which are there from the component auditors and whether they need to be summarized or included in his report or not. So various appendices are there in the guidance note, which talks about engagement, team discussion level, what should happen with respect to fraud, the checklist for inquiries with board, audit committee, and the management and internal auditors, the fraud risk factors, possible audit procedures to address the assessed risk of material misstatement, reporting to the board or the audit committee, reporting to central government under form ADT 4, and the management representation letter. So these are the various aspects which the guidance note covers in detail. As I said, I cannot narrate all those 50, 60, 70 pages which are there either in the standard or the guidance note. So this is just the gist of what it covers and some of the key elements. You will have to go back to the drawing board, specifically in cases where you have identified such matters or you think that there is a possibility of such matters. Such matters means the frauds. A practical issue: how does an auditor assert fraud when traditionally his/her duties are confined to performing enhanced audit procedure to ensure financial statements are not misstated? So again, on the cost of repetition, as I said, the auditor does not legally determine whether the fraud has actually occurred or not. There is a significant judgment which needs to be applied. And since fraud is a criminal offense under IPC 1860, where the intention or mens rea is to be established, what we say opposite of bona fide is your mens rea, there was an intention to do wrong. The auditor will not be in a position to assert that the fraud has happened. Therefore, when a suspicion of fraud is reported by the auditors, the board or audit committee is required to evaluate that matter, take appropriate action, including conducting an investigation, a detailed investigation, or a forensic audit, either using their own in-house team or seeking experts. And further, the board or the audit committee is expected to respond to the auditor within 45 days of the suspected fraud being highlighted. So I think indirectly this is also saying, giving a hint of what the audit committee and the board should do, that they should do further investigation in detail once the auditor has brought it to their notice within 2 days of the auditor becoming aware about it. And based on the appointment of the investigator, whatever are the findings would be a response from the board or the audit committee to the statutory auditors, who may incorporate that and give his comments thereon while submitting ADT 4. Yeah. Very, very, I think, detailed exercise in these cases. One more question or practical issue which comes is, can non-compliance be considered fraud? Now, again, non-compliances are of two types. One is an intentional non-compliance and one is a non-intentional non-compliance. And some of the types of non-compliances are like corruption, bribery, money laundering, or other regulatory non-compliances committed by the employees of the company. In such cases, they also may have to be reported. The auditor may have to consider reporting that to the audit committee or board, and considering the value, may also have to report it to the central government, depending on the value of fraudulence. So I think it is much broader than the actual fraud. If there is some more insights, items like this, bribery, corruption, then those items may also get covered under 143(12). So this broadens the scope of the auditor's responsibility with respect to such items also. How does one determine the quantum of fraud? This is the next question. That you have identified that there is a fraud, but how do you quantify it? And there, the MCA notification permits the use of management estimate or a reasonable range of estimate made by the auditors for the purpose of reporting fraud. However, where estimation of the amount is not always feasible, and if estimation goes wrong, then one can end up reporting a less than 1 crore fraud or not reporting fraud above 1 crore to appropriate authorities. Also, subsequent reporting may be required if amount was initially estimated to be lower than 1 crore, but eventually, based on subsequent events and more evidence which was gathered, it was finally established that the quantum of the loss is exceeding the prescribed limit of 1 crore, then that subsequent reporting within 45 days of determination of the revised fraud loss will be applicable. So again, there are so many practical challenges around this subject. So it's not very easy always for the auditor to say that this is something which is correct and this is something which can be directly reported. He may have to go through the process of quantification, computing probable loss, use some estimates, use the judgment, and based on that decide whether reporting is mandatory or not mandatory. Before we go to the third section of the CARO reporting and the reporting under NAFRA, again, one more powerful statement made by Ajay Bhushan Pandey sir, who is the NAFRA chairman, that audit should not be a ticking audit, but a thinking audit. And I think very clearly, this is what has been echoed by various regulators, not only in India, but internationally, that you cannot merely do the tick box approach or a mechanical approach. You have to analyze, evaluate, you have to use your judgment, you have to think about the possibilities, and based on that, form your opinion and judgment. So I think it's high time that if people are not abiding by the auditing standard or the guidance note or the law, they should do this, because the more such instances are identified by the regulators, they are making the requirement that much more stringent for the auditors, and that becomes difficult to then implement in a normal course. So we now go on to the famous NAFRA circular, and there it is very clearly said that the statutory auditors are under a mandatory obligation to report fraud or suspected fraud if they observe suspicious activities, transactions, or operating circumstances in a company that indicate reason to believe that an offense of fraud is being or has been committed against the company by its officers or employees. In fact, the NAFRA circular starts with a statement that they have found cases where the auditors are not complying with this requirement and are not reporting as required by 143 subsection 12. They need to initiate steps prescribed in Rule 13, which begin by reporting within 2 days to the board and the audit committee once they have the knowledge of the fraud, and seek their reply within 45 days. And that fraud involving or expected to involve individually an amount in excess of 1 crore or more. And if the auditor fails to get a reply within 45 days, the auditor shall forward a report in the specified form with ADT 4 to the secretary, MCA, and GOI. So I think this is very important that the regulator, we take the regulation seriously, we take their comments seriously, we take their circular seriously, and ensure that we abide. Otherwise, the credibility of the auditor and as the audit profession would really be at stake. So what is the reporting requirement under the NAFRA circular? It says the statutory auditor is duty bound to submit Form ADT 4 to central government under Section 143(12) of the Companies Act, even if in case where she is not the first person to identify the suspected fraud. Now, if you see not the first person to identify, I think that should have been bold, but it's not bold just now. That's very important. This is in contrast to what the guidance note issued by Institute on 143(12) states, that the auditor's responsibility is only when he is the first person to identify or first person to become aware about such a fraud. So I think this significantly expands the horizon of reporting or the responsibility of the auditor. So auditor will have to do that much more checking. If the fraud is not identified by the auditor, then he will also have to look at the FIR and the other information which is available, and accordingly decide his next course of action. The circular also goes on to say, and it has, I think, cited in one case, that the resignation does not absolve the auditor of her responsibility to report suspected fraud or fraud as mandated by law. So the moment you identified a fraud or you became aware of a fraud and then you decide you have to resign, you resign immediately after that. That is not a solution. You cannot run away or escape from your responsibility once you are aware. Once you are aware that there is a fraud which has happened, you have to take it to its logical conclusion in terms of your reporting obligation. And resigning in between is not a solution which is acceptable under law. It also says that the statutory auditor shall exercise her own professional skepticism while evaluating fraud, and he should not get unduly influenced by the legal opinion which is provided by the company or its management. So you see the level of depth in which NAFRA circular is going. It is first reprimanding the auditor community by saying that they have not been fully compliant. Then they are saying that you are duty bound, irrespective of whether you came to know it yourself or management informed you. You need to report it under ADT 4. You cannot escape the responsibility by taking any easy route of resigning. You should use your own judgment, your own intellectual and intelligence, rather than relying on a legal opinion. Because legal opinion sometimes may not be as reliable as you doing the audit may be aware about a lot of more things. So the NAFRA circular has really taken a lot of pain to identify and guide the auditor in terms of their immediate responsibility. So this is as far as the NAFRA circular is concerned. As I said, this was, I don't remember the exact date, but this was around 2 months or 3 months back where the circular has come. If required, I'll pull out that date and share that also during the subsequent, when I close this file and open the circular. So be careful. If you find anything like this, take help of experts wherever required so that you are not misguided in terms of the steps which you need to take as auditors. Next, we will go to the reporting under CARO 2020. So if you remember, earlier in CARO 2016, there was a requirement for reporting on the fraud by the officers or employees. Now the word officers or employees has been removed, and the clause 11A of CARO says that whether any fraud by the company or any fraud on the company has been noticed or reported during the year. If yes, the nature and amount involved to be indicated. So this scope is now broader, and frauds detected by the management while reviewing internal financial controls or internal audit, or by way of whistleblower mechanism and brought to the notice of the auditors are also covered under this reporting. So it is not, so 143.12 has a restriction, but here there is no restriction and there is a direct reporting. So you had an essay, you had a guidance note on 143.12, you have 143.12 itself, you have NAFRA circular, and now you have CARO 2020. So see the amount of literature or the amount of compliance guidelines which are there for the auditor to ensure that the reporting is appropriate. The 9B says whether any report under section 143(12) has been filed by the auditor in form ADT4 with the central government. Here, obviously, if it is there, you will have to say yes and give details. If it is no, you will have to state no. And the 11C talks about whether auditor has considered any whistleblower complaints received during the year by the company while making a judgment on these suspected frauds or frauds have happened or occurred or not occurred. So three things. One is reporting on fraud. While reporting on fraud, did you consider the whistleblower complaints? And three, did you report any of those frauds to the central government? There is another clause in CARO with respect to transactions not recorded in books of accounts and have been surrendered or disclosed as income during the year in tax assessment under Income Tax Act. If so, whether the previously unrecorded income has been properly recorded in books or not. Now, this itself means that there is some wrongdoing. If you have not recorded something which should have been recorded or which was disclosed to the authorities. So if any such transaction is disclosed during audit period, you also need to assess whether this constitutes itself a fraud or not. And correspondingly, what will be the reporting requirement besides this particular clause, whereas is there an additional or a dual reporting? Because that dual reporting is something very important, either under 143(12) or CARO other clauses or under IFC. So, you need to linkage. Otherwise, you will report here, and if you do not report there, then it is an incomplete reporting because the same transaction, two separate questions are asked in a different manner, and the answer to both needs to be properly given. The next is director's responsibility statement shall include details in respect of frauds reported by the auditors. The director shall state that they have taken proper and sufficient care for maintenance of adequate accounting records. This is under 134(5), and if you remember, we had touched upon this earlier also, that they have taken sufficient care for ensuring that the controls are sufficient and adequate and to both prevent and detect the frauds. Let's shift the next section, which is on the company's obligation on reporting of frauds. And there are multiple areas where company themselves are obliged. So there is for NBFC, there is reporting on frauds by regulation by the Reserve Bank of India, where they have into 4 categories: frauds involving 1 lakh and above, frauds involving 1 crore and above, frauds committed by unscrupulous borrowers, and cases of attempted frauds. And there are forms and there are limits, and the company needs to inform about this to RBI. This is a regular reporting which is required to the regional office or whichever offices has been prescribed. And it is very important that as auditors of these NBFC, we ask the company and get copies of these reports which the company has submitted to the Reserve Bank of India for ensuring our compliance with reporting on frauds. So the company already has done certain work with respect to the fraud reporting, and you will have to take cognizance or take that into consideration while ensuring that you report correctly in your audit report or CARO or under 143(12). Along with reporting of fraud to RBI, quarterly returns of report of fraud, outstanding and progress report on frauds, that also has to be submitted by the company. Report to the board of reporting on frauds, quarterly review of frauds, and annual review of frauds also to be complied with. So the NBFC is a regulated industry, and there very clearly some of these regulations are there. There would be other industries where the respective regulators may have prescribed the guidelines for the company to report in case the company management identifies a fraud. So you may have to go through that particular industry. So whether it is insurance, whether it is banking, whether it is any other regulated industry, try to find out whether there are any obligations of the company to report the fraud. Company is also obliged under the listing agreement, listing and disclosure regulations, that and that is regulation 30 and 17 subsection 8 subclause 8 subrule 8, that fraud, default by promoters, KMPs by listed entity, or arrest of KMP promoter to stock exchange within 24 hours of the occurrence of the event, fraud, default by directors other than KMP or employees of listed entity upon application of guidance for materiality, and significant fraud on becoming aware and the involvement therein, if any of the management or employees. So listing agreement also cast certain obligation, certain reporting, conditions for the listed entity to the stock exchange, and you should make the inquiries and see whether any such reports have been filed or not filed. And if these reports have been filed, then you will have to consider these reports while doing your reporting under 143.12 CARO and other areas. With this, we come to the last section on my presentation, which is some examples from published accounts of how auditors have addressed the fraud reporting. Unfortunately, I could not get any ADT 4 forms because they may not be in public domain. So those forms could not be, I could not lay my hands on it to share any portion of that. But we will still try to cover as much as we can. So first is in March 23, Mahindra and Mahindra Limited. They have said that considering the principles of materiality outlined in standard of report auditing, we report that no fraud by the company or on the company has been noticed or reported during the course of the audit. And it's very important to understand that they have given a reporting of no fraud, considering the principle of materiality, which is outlined in the standard of auditing. So they are saying if these were non-material, then we have not reported it over here. So if they were smaller amounts, we have not reported it here. And you need to understand that here the reporting is for all types of frauds, whether it is done by a customer or whether it is done by a supplier or the vendor, and not necessarily the officer and the employees. So here they are in a way saying that because the frauds which were there are not there beyond the materiality level which has been prescribed. So they have triggered that materiality level standard. The next one which we have is on the Muthoot Finance Limited, where fraud committed by employees and customers of the company amounted to X amount. In the previous year, figure is also given, which has been recovered, written off, provided for. So they are saying that it has been appropriately dealt with in the financial statements, either by subsequent recovery or by writing it off or providing for it. Of the above fraud by employees of the company amounted to X amount. So they are saying this was the total fraud and this is the fraud which is there from the employees. And the CARO report not only gives the reference of that note, but also provides the amount of 52.16, which is in totality, because it does not restrict to the only one particular employee and officers, but all types of frauds, CARO. Here, incidentally, we do not know whether the overall quantum was greater than 1 crore for any one particular fraud, because these are several frauds which were identified during the year. And so that's what we just wanted to say. And obviously the last statement is no fraud by the company, because generally how will the company itself accept that they have done some fraud? So that's the last statement in the CARO report. Ken Fin Home Limited has in fact given an exhaustive table with the nature of fraud, the amount involved, and then additional remarks. And this is a reporting under CARO. So loan granted on the strength of improper document of the borrower and or guarantor. And then it says the company has reported 40 accounts as fraud, of which 35 have been closed and balance outstanding as on 31st March is 37 lakhs, 0.13 lakhs, for which 100% provision has been made. So they're saying 40 reported 40 accounts as fraud, of which 35 have already been closed and properly provided. Amount received from the borrower not credited to borrower account by the employee of the company. So this is an employee related fraud. Amount has been recovered by the company. So they would have asked the employee to leave, and during the full and final settlement, they have recovered this amount. Misrepresentation of facts and manipulation of documents. The company has reported 4 accounts as fraud, of which 1 account has been closed and the balance outstanding as on March 31st, 23 was 47.84 lakhs, for which 100% provision has been made. So you see everywhere they are saying that this has been appropriately dealt with in the books of accounts. Multiple finance for the same property, current outstanding is 18.3 and which has been provision has been made. So they have, wherever they could give more description or more classification or more breakup, they have tried to do that so that the reader is able to understand that where are these frauds coming from. On Tata Steel, it says that during company had received a whistleblower complaint during the year, which has been considered by the auditor for any bearing on the audit and reporting under this clause. As explained by the management, there were certain complaints in respect of which investigations are still ongoing as on the date of our audit report, and hence the impact on our audit report in respect of those complaints cannot be determined at this stage. This is again like a limitation or a disclaimer which they are giving, that there were whistleblower complaints, and these whistleblower complaints are still the management is also trying to get into further details. And because those further investigations are in progress and not complete, the impact cannot be determined at this stage. In case of Mannapuram, there are certain instances of fraud on the company by the officers and employees where gold loan related misappropriation, cash embezzlement, burglaries have occurred for amounts aggregating to so much, previous year so much, of which the company has recovered so much. The company has taken insurance cover for such losses and filed insurance claim in this regard. Further, the company is in the process of recovering these amounts from employees and taking legal action where applicable. In addition, the company has created provision aggregating to so much amount towards the losses based on its estimate. Again, very descriptive in terms of the total loss, the loss which is information as regards insurance and insurance claim filed, taking legal action, recovering, and then provisioning. So all 4 aspects are covered. That's it from my side. I've tried to cover as much as I can. And basically, one second, I'll just tell you the circular number. So it's June 26, June 23 that this circular has come from NAFRA. So which also you all should go through in detail. The bare section, the guidance note, the auditing standard, all of it should be referred to when you have any doubts. And obviously listed company reports and other publicly available information can also be reviewed and analyzed before you form your opinion. And in case you are still stuck, you should take expert advice or a third-party advice. It could be another chartered accountant with more exposure and experience. It could be a lawyer. It could be any other expert in the field. I hope I have done justice to the topic of fraud.
Yes, sir. Yes, sir. Thank you so much, sir. Can you hear me?
Yes.
Video. Can you hear me, sir? Thank you so much, sir. You have covered all the aspects and the covering the illustration also. So thank you so much on behalf of AASB, sir. I have received certain queries from the members. If you allow me, I take.
Yeah.
So first question is, one member is asking fake purchases and sale bills. He's saying even wrong stock statements given to the banks on the basis of which big credit limits have been sanctioned by the banks. Then in that particular case, what to do?
Yeah, so the fake purchase and fake sale bills, if you are able to identify, then you have an obligation to report it. How will you identify is a question mark. If the management has already identified and informed you, then your response has to be appropriately. You need to take it ahead. If the value is more than 1 crore, then you have an obligation to report as per the NAFRA circular. When it comes to the stock statement or debtor statement for the purpose of drawing limits, in fact, CARO 2020 has been amended where now, wherever the limits are more than 5 crores, the auditors have to report that the quarterly statement which are submitted to the bank or the financial institution from where the money is borrowed, whether they are in line with the books of accounts, and if not, what is the variance between what is reported to the in the bank statement given to the bank versus what is there in books of accounts. So I think there is a clear reporting which is required, and that same reporting, as I said, could come at multiple places. So if the variances is very, very significant and it's not a justifiable reason, or you're not able to reconcile with that, see, if there are minor differences, you can say that these could be on account of subsequent entries. But if the gap is with an intention to have more borrowing, and if you're able to identify it, then you will have to report it at multiple places. As I said, dual reporting.
Yes, yes. Sir, even I hope you have covered something relating to this question. If an FIR has already been filed and police is investigating, but nothing substantial in evidence is available, and amount claimed to be fraudulently siphoned is more than 1 crore, then in this particular case, what CA is supposed to do?
So see, as I said, you are not responsible for finally stating whether a fraud has happened or not happened. That's a legal subject. It is not as easy. It's a complex thing. Mens rea is what we spoke about. So I think the auditor should not dwell further. Once an FIR is filed, he has to report it, and then he can say that the pending further report or any conclusive evidence is awaited from the regulatory or the police department or the CBI or the ED, whichever is there. I think these are cases where he will have to state the facts as it is without being biased either way, and just share those information with the readers.
Yes, yes. So in current situation, auditor work with honestly, and thereafter he has serious accused in comparison to the main accused. So why?
Unfortunately, some amount of blame is our community itself, where in certain cases we may not have been diligent enough as a community to report, and because of few bad apples, I think there is the government has made it tighter and tighter, and in fact, it has reached a level where complying has become almost like an impossible position. And I think if institute and the members need to work together to bring back this credibility, the trust deficit on the auditors which has got developed, that needs to be addressed at various forums. But your question is more of a, there is nothing which I can answer from a technical
Yes, yes,
perspective, but I'm sharing
yes,
my personal views on some of
yes,
these.
yes, 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 yes. Sir, closing stock in trade not verified in full. If so, then so qualified, does it relieve the auditor?
Sorry, the closing stock is not verified by the auditor or the management?
Closing stock in trade not verified in full, fully not verified
Okay, so
by
you've
the
done a test.
verification.
So there is not a
Yes, yes.
100% verification. There is a test verification. Yes.
Test verification. So auditor is relieved in on those grounds if some fraud happened.
See, the standard does not require auditor to be present 100% of the verification. He has to ensure that the process which the management has for the physical verification is adequate or not. So he may send his representative who may do a test check, and during test check, if nothing is identified, now how much should be the sample size could be a matter of judgment. His past historical experience with that client. If it's a new client, he may have to be more careful. So I think you cannot give a direct answer of yes or no that you will be relieved. But if you can, what you can say, if you can prove beyond doubt that you tried to fulfill your obligation sincerely and correctly by following all the steps, inquiring with the management, looking at the management process, doing a test check verification, and after that, still it was not identified, then audit is not 100% guarantee. Yeah. So in such cases, I think if the documentation is in your support and you have followed the due process, you would be questioned, but you should be reasonably okay as compared to being allegated that you were perpetrator of that or you were in collision with the management.
Yes. So penal lawyer is supposed to vet the documents and give opinion. When fraud takes place, lawyer says it is not their duty to physically inspect the property and auditor is held responsible. Then how far this is correct, sir?
Sorry, I did not understand. Again, this is a question which is the law is as it is prescribed. There are certain obligations on the auditor. Now, you may challenge that this requirement is unreasonable. We may have a view, but that doesn't change the law. The law requires you to do certain due process of audit test, audit procedure, audit inquiry, analytical procedure, the gathering of evidence, making a judgment on that evidence, and reporting on it. You may feel that this is an onerous burden. Yes, it could be that way, but that does not mitigate your responsibility. And I think we are not here to challenge the law, but to interpret the law and comply with the law. There are other bodies which will try to change the law or make a impact in terms of influencing. And I think Institute would be doing its part of it in that area. But for us as chartered accountants who are auditors, we should abide by what is already there rather than
Yes.
changing it.
Yes, yes. Sir, the amount quantum of 1 crore, what precautions we take while we determining the quantum of 1 crore or more than 1 crore?
I think I already mentioned it's the estimate. You may want to be slightly conservative so that you err on the other side rather than erring on this side. So if you are, maybe you can keep a contingency margin of 5-10% while assessing that fraud quantum. But in general, like you do any other activity, any other estimate, try to do it the same way. And if it is not estimatable, then you will have no choice but to report, saying that you are not in a position to report whether it is in excess of 1 crore or not.
Sir, if an auditor finds a fraud of previous years, which is not materially impacted current year financials, whether he still need to report the same?
That is the earlier auditor's responsibility, in my view. And it does not carry forward because you are doing an audit for a particular financial year. You're presuming that the earlier auditor did their job correctly. At the most, if you find that it has a lot of impact, you may want to check as a professional brethren with your previous auditor on an informal or a formal communication and then take a view. But I would feel that you can safely say that that's outside the domain. But as you saw the NAFRA circular is expanding the scope. So do not take it lightly. If the amounts are material and you feel that these are very relevant, take a precautionary, conservative view.
Yes. So whether fraudulent policies or any sort of procedures which are not aligned, say reported by a customer, need to be reported and how to evaluate?
They should be reported if they have a financial impact which is exceeding 1 crore or less than 1 crore to the I'm not sure what does this question really mean. Is it that the customer is there is a bribery involved in the contract or with the customer? Is there any other wrongdoing in terms of the quality of the products? The specifications are different when the order was first finalized versus when the delivery was made. So it's very difficult to answer that question. But on a case-to-case basis, if there is a financial loss to the company and it was intentional, but here it is the customer. So at least 143.12 will not get triggered because it is only employees and officers, unless the employees and officers were involved along with the customer while doing that fraud.
Yes. So two more questions.
Yes, sir.
In case of tax audit under section 44AB of the proprietorship or partnership form, is it necessary to report in the form 3CB the inflation of sales figures with the bogus case sales?
Yes, sir. It is. It is. It is. I think Income Tax Act is very clear, and you need not go through the Companies Act regulations on that. But the normal standard and the normal attest function, because when you are giving a tax audit, the income tax officer is relying on whatever you have identified. And if you have identified, I think there is an obligation. Now, if you have not identified, then what happens is a different issue. But once identified, I think it should be reported.
Yes, sir. So one last question. One member is saying, we engage in IBA approved firm for transaction and forensic audit under section 43, 45, 46, 66 of IBC. Where will transactions and forensic auditor report in addition to resolution profession under Bankruptcy Code 2016?
But that's not a subject which I'm an expert on.
Yes.
Sorry, I'll have to pass that question. I did not
I will
understand.
forward the same then query I will forward to the concerned member, sir.
Yeah, I may not be able to answer it correctly. It will be more of my general understanding. So I would try to refrain from that question. Sorry. It's a question on IBC Act, right, sir? It's on the Bankruptcy Act. Yeah.
Yes, yes, sir. Sir, last question. One member is saying what precautions one auditor has to take while the auditing in order to, because it is fine that it is not the matter to take the check the fraud, but how to it is a matter of quality check. So, what precautions and what suggestions you take while auditing the same?
So I have, during the whole process of this presentation, I have spoken about SA 240 and the other essays on risk assessment. And basically, the auditor should follow the various steps, be it at the planning stage, be it at the actual audit execution. Once he identifies certain indicators, then how does he expand or do additional audit procedures, inquiry with the management, external confirmations or any other external evidence, gathering of those evidence, evaluating them. I think if the auditor does the audit correctly, in the right way the audit is supposed to be done, that itself would be a huge safeguard. If the management has not shared transparently certain facts, then the auditor cannot be held responsible for that. And hence he should document all meetings with the management, as well as the management representation should cover those aspects. So I think the fact that you are doing an audit, there is a risk which you are taking because there is a huge an enormous responsibility. But if you follow your steps and you are able to demonstrate that you did your diligence and your audit procedure correctly, you should be fairly okay.
Yes, yes, sir. Thank you so much, sir. Now we are come to an end. We are having with the Honorable Chairman of Jalandhar Branch, Abhishek, sir.
Yeah.
Sir is here. Sir, kindly propose final vote of thanks, sir.
Yes, sir.
Yeah, Vijay.
I would like to thank everyone for joining us today for such a fruitful and knowledgeable webinar. Thank you so much, Sir Milind Modi ji, for deliberating on such an important topic and for guiding your knowledge to our members. Thank you so much, sir. Thank you, Anil ji, for giving me the opportunity also. Thank you. Thank you, all the members, for joining us today. Thank you.
Thank you so much, sir. Thank you so much, Milan, sir, for sparing your valuable time. And hats off to you. Are always give your consent whenever I call you. And in spite of having busy schedule, LR, as well as the various audit committee meetings, always you are available for the cause of the profession, sir. Thank you so much, sir. Thank you. I also extend my warm thanks to the Honorable Chairman of Jalandhar Branch, Sri Abhishek Bansal ji, for co-hosting this webinar and moderating this webinar. Thank you so much, sir. Thank you so much on behalf of Auditing and Assurance Standard Board. Thank you, sir. Thank you, sir. Namaste.
Thank you.